The petrodollar will not die the way most people imagine. It will not die with one dramatic speech. It will not die because some politician announces a new era on television. It will not die because one morning the world wakes up and decides the dollar is over. That is the childish version. The real version is quieter, slower, and far more dangerous. A reserve system does not usually break in slogans. It breaks in habits. It breaks when enough essential transactions stop needing it. It breaks when enough counterparties discover they can settle without it. It breaks when old buyers become conditional instead of automatic. And it breaks fastest when the issuer at the center of the system needs those old habits to remain intact more than ever before. That is where I think we are now, not at the end of the dollar. I am not interested in cartoon prophecies. I am interested in stress fractures. And the fracture I see is very simple. The world is beginning to test how much oil can move, how much trade can clear, and how much value can be stored without first passing obediently through the dollar system. That is the real event, not a headline, a test. And if that test keeps spreading while the United States is drowning in debt, then the thing being repriced is not only oil, not only Treasury auctions, not only exchange rates. The thing being repriced is confidence itself. That is what people miss. They keep asking whether the dollar is still dominant. That is the wrong question. The better question is this: how much of the old automatic demand for dollars is still truly automatic? Because once automatic demand turns into negotiated demand, conditional demand, reluctant demand, or bypass demand, the entire machine changes character. That is the beginning of the real story. Now let me say something plainly. The dollar has not been backed by gold since 1971. Everyone knows that sentence. Very few people understand what replaced the gold anchor in practical life. Oil not in the magical sense, in the demand sense. Once the United States and the major oil powers settled into a world where the most important commodity on earth was routinely priced in dollars, something extraordinary happened. Every country that needed oil needed dollars first. Every importer needed a dollar stockpile. Every central bank needed reserve assets linked to the dollar world. Every large trading system had to respect the rails of dollar settlement. That created a permanent bid, not a sentimental bid, a functional bid that matters enormously. A reserve currency is not merely strong because people admire it. It is strong because enough of the world must hold it whether they admire it or not. That is what made the post-1971 system so durable. The dollar was not just a currency. It was an operating requirement. And once something becomes an operating requirement, its issuer acquires a privilege so large that most of its citizens stop even noticing it. That privilege was not abstract. It lowered financing costs. It deepened Treasury demand. It allowed the United States to run larger deficits for longer than ordinary countries could survive. It made war, welfare, tax cuts, rescue packages, and serial postponement of discipline much easier to finance than the American public ever honestly admitted. That was the subsidy, not just reserve status. Automatic global need. That is why the present moment matters so much. Because if oil increasingly moves outside the old dollar-only habit, even in partial channels, then one of the deepest sources of automatic demand starts weakening. At exactly the moment the United States needs more financing, more rollover support, and more creditor patience than at any other point in modern history. That is not a small problem. That is the kind of problem empires spend years denying and then a decade paying for. Now, before we go further, I want to make the main line even sharper. The danger is not that one route, one country, or 1 month of trade settles in yuan. The danger is that the world is building muscle memory for bypass. That is the phrase, muscle memory for bypass. Once people learn they can clear essential trade without touching the dollar first, they do not need to overthrow the old system overnight to weaken it. They only need to keep practicing the alternative. That is how reserve architecture erodes, not in one glorious revolution, in 1,000 practical workarounds. And practical workarounds are much harder to stop than ideological speeches. Now let us walk through the mechanism the way serious people should. The first mechanism is what I call the tollgate fracture. Most people still think the Strait of Hormuz story is just an oil shock story. That is too small. It is also a settlement story. If a critical energy choke point remains passable, but passage increasingly comes tied to non-dollar settlement, then the world is being handed a live experiment. Can vital trade clear outside the old mandatory dollar chain? That is the test. Notice what matters here. Not whether the route is totally closed, Not whether every ship suddenly pays in yuan tomorrow. What matters is that a geopolitical crisis is being used as a forcing function for alternative settlement behavior. That is how systems change. Crisis does not merely create price pressure, it creates permission to try new rails, permission to settle differently, permission to discover that what was once treated as mandatory may actually have alternatives. That is why I care so much about Hormuz in this moment. Not just because it moves oil, because it exposes dependence. And once dependence is exposed, people start looking for exits. Now let me say something that the public almost never hears clearly. Reserve currency power is not mainly about theory, it is about inconvenience. The dollar remained supreme, not just because it was trusted, but because it was hard to avoid. The trade contracts were in dollars. The payment systems were in dollars. The banks clearing the flows were tied to the dollar world. The deepest reserve asset was the U.S. Treasury market. The commodity that everyone needed was priced in dollars. That is an ecosystem. And ecosystems are powerful because they make the dominant choice feel natural. But ecosystems can be weakened if enough friction builds against them and enough infrastructure grows outside them. That is the second mechanism. I call it the alternative rail effect for years. People dismissed the idea of dollar alternatives because the alternatives were too clumsy, too shallow, too underdeveloped, or too politically inconvenient. Fine, that was once true to a large extent, but the key mistake people make is assuming that an immature alternative is no alternative at all. That is foolish. Alternatives do not need to be perfect. They only need to be good enough for enough transactions in enough circumstances. China understood that. That is why the yuan oil contract mattered. Not because it instantly dethroned the dollar, because it created an option. That is why CIPS matters, not because it replaced the entire Western system. Because it gave counterparties another pipe. That is why Enbridge matters. Not because blockchain slogans solve geopolitics. Because governments under sanctions, surveillance, or strategic pressure want clearing paths the old system cannot easily choke. That is why the gold corridor matters. Not because gold nostalgia suddenly returned. Because settlement and reserve management are beginning to look more physical, more regional, and less obedient to the old single center model. This is what the public keeps missing. No one new rail needs to dominate the whole system. A cluster of alternatives can gradually weaken the necessity of the old one. That is the point. And once necessity weakens, privilege begins repricing. Now I want you to see why this matters so much more to the United States than to everyone else. A normal country losing some reserve prestige is unfortunate. A country with $30+ trillion of debt, massive annual deficits, huge refinancing needs, and a political culture addicted to spending while pretending arithmetic is optional is in a completely different position. That is the third mechanism. I call it the demand engine. The dollar system is not just a prestige machine, it is a funding machine. When the world needs dollars to buy oil, settle trade, and hold reserves, it also ends up buying dollar assets. Most importantly, treasuries. That is what keeps the sovereign funding structure livable. Not beautiful livable. Because if the United States had to finance itself on purely ordinary country terms, the illusion of unlimited fiscal elasticity would have died a very long time ago. That is the uncomfortable truth. America's debt habits were subsidized by the world's need to hold what America printed. Now ask yourself the question most people avoid. What happens when the world still needs some dollars, but fewer of them at the margin, and is increasingly willing to clear important transactions elsewhere? The answer is simple and brutal: less structural demand. Less structural demand means weaker auction support. Weaker auction support means higher yields required to clear the same amount of paper. Higher yields mean larger interest expense. Larger interest expense means bigger deficits. Bigger deficits mean more debt issuance. More debt issuance means you need even more buyers. That is the loop. That is not theory, that is the machine. And machines like this do not care whether the people living inside them feel emotionally prepared. They run until something gives. That is why I say the dollar issue is not a culture war topic for me. It is a funding topic. If demand for the dollar weakens at the same time the government requires ever larger debt buyers to refinance old obligations and fund new deficits, the price of financing rises. And once the price of financing rises enough, the rest of the financial world must reprice around it. That is the fourth mechanism, the debt doom loop. I know people love that phrase because it sounds dramatic. Fine, but the reality is more boring and more dangerous than the phrase. A doom loop is simply this. You owe so much that the interest on the debt becomes a major spending category. To pay the interest, you borrow more. Borrowing more pushes the total debt higher. Higher debt makes markets more nervous. More nervous markets demand higher yields. Higher yields increase the interest bill, then you borrow more again. That is the loop. The reason the U.S. can even pretend to live inside such a loop for as long as it has is that the dollar system kept feeding demand into Treasury markets as a matter of global habit and necessity. If that necessity begins eroding, then the loop accelerates. That is what so few people are taking seriously enough. The danger is not only that debt is large, it is that one of the most important support beams under debt demand may be gradually weakening just as rollover needs become immense. Now let me bring in Treasury auctions, because this is where the abstract becomes painfully real. Weak auction demand is not just a market curiosity, it is a message when 2-year, 5-year, and 7-year notes clear at weaker than expected demand. The market is telling you something precise. The buyer is there, but not at the old terms. That is what higher yields really are, a demanded concession. A price increase the issuer must pay because the old level of trust, old level of urgency, or old level of structural need is no longer sufficient. That matters much more than people think, because in a system with normal debt levels, a few weaker auctions are just noise. In a system with gigantic rollover requirements, chronic deficits, and a fading aura of automatic reserve demand, weak auctions are part of the story of repricing, and repricing sovereign funding cost is not a side plot. It is the plot. That is why I care so much more about the structure than the headline. The public still looks at the dollar and sees a strong index, a dominant role, a huge bond market, and habit. I look at the same system and see increasing term premium, mounting refinancing pressure, rising interest expense, and a global incentive structure that now favors building alternatives to the old single choke point. That is a very different picture. Now I want to say something uncomfortable. A lot of people talk about the dollar system as though it were purely a matter of trust earned by excellent management. That is, naive power mattered, depth mattered, military reach mattered, commodity pricing habits mattered, payment infrastructure mattered, and yes, coercion mattered. Once the United States showed the world that access to the dollar system could be weaponized strategically, the rest of the world began drawing the only reasonable conclusion. Over-reliance is dangerous. That is not anti-American. That is common sense. If the main settlement system can be used not just economically but politically, then every serious state has an incentive to build optionality. That optionality may be crude at first, it may be regional, it may be partial, but once the incentive exists, the direction of travel is set. That is the fifth mechanism, weaponization backlash, and that is part of why I think this trend is much deeper than one war, one oil route, or 1 month of settlement experimentation. Geopolitics created the motive, debt created the vulnerability, alternative rails created the means. That combination is enough to matter. Now let me connect it directly to your life, because this is where many people still hide behind abstraction. They hear reserve currency stories and think it is something for central banks, trade ministers, and macro tourists. Number it is about your money. If demand for dollars weakens at the margin, the United States must increasingly choose between two painful paths: pay more to attract funding, or protect funding conditions by compromising the currency. Those are the broad choices. If it pays more, then rates stay higher than people want. Financial assets repriced off the long end come under stress, deficits worsen faster, and the economy carries more pain. If it compromises the currency, then savers pay through purchasing power erosion, inflation pressure, and eventual loss of confidence in nominal claims. Either way, somebody pays. That is the whole point of these late-stage debt systems. There is no pain-free path left, only distribution choices. That is what people do not like hearing. They want the Fed to save them. They want the Treasury market to rescue them. They want one more cycle in which everybody pretends that debt can be rolled forever at tolerable terms because the world has no alternative. I do not think the world needs a perfect alternative to begin weakening the old privilege. It only needs enough alternatives to make demand less automatic. That is already happening. Now let me be very clear about one thing. I am not telling you to bet on some overnight collapse in the dollar. Overnight collapse thinking is how unserious people entertain themselves. I am talking about regime deterioration. Regime deterioration is slower, more political, more uneven, and often more expensive than apocalyptic thinkers. Imagine it also matters much more, because it quietly changes everything in the portfolio. Long-duration bonds become less comfortable. Broad index exposure concentrated in expensive growth names becomes more fragile. Cash becomes less safe in real terms. If the response is suppression and debasement, gold becomes more relevant, real assets become more relevant, pricing. Power businesses become more relevant, optionality becomes more relevant. That is what I mean by repricing the privilege. When the old reserve subsidy weakens, the hierarchy of safe assets changes. That is the sixth mechanism, the saver squeeze. People think inflation is the main way savers get punished. Inflation is one way, financial repression is another. Negative real rates, managed yields below inflation, policy that looks like support for the system while quietly taxing prudence. That is how late debt cycles often get resolved. Not only by dramatic breaks, by slow theft. And if the petrodollar weakens enough to force more aggressive domestic financial management of the debt load, then the saver squeeze intensifies. That is why I keep saying this is not an oil story. It is a purchasing power story. It is a retirement story. It is a bond market story. It is a currency confidence story. Now let me bring in gold directly, because if I am talking honestly about a world where the dollar's automatic demand engine is weakening, then I must also talk honestly about what sits outside that promise structure. Gold matters here not because of romance. It matters because a reserve system under strain makes neutral assets more attractive. Not immediately and every week. Markets are not that polite, but structurally, gold does not need the Treasury auction to go well. Gold does not care whether Congress behaves seriously. Gold does not require foreign central banks to keep subsidizing U.S. deficits. That is why central banks keep buying it. They are not making a philosophical statement. They are making a reserve statement, and if the world keeps building non-dollar settlement rails for trade while still accumulating gold, the message could not be much clearer. They want options outside the old chain. That matters. Now, I want to be practical because none of this is useful if it ends in grand mood and no operating framework. What do I do with this view? First, I stop thinking of long duration nominal claims as unquestionably safe. That includes long treasuries. That includes any portfolio built on the assumption that the old bond bull market still exists in spirit if not in name. I do not believe it does. Second, I increase my respect for optionality, cash, like instruments with short duration, liquidity not tied to dramatic rate risk, capital that can move when others are frozen. Third, I treat gold and real assets as serious portfolio components rather than fringe insurance. Fourth, I care much more about pricing power. If the system resolves its debt burden partly through inflation and monetary compromise, then businesses that can pass through higher costs become much more important. Fifth, I stop trusting the old safe haven reflex as though it were sacred. That does not mean treasuries become worthless. It means their privilege becomes more conditional. Conditional privilege is a very different thing from unquestioned supremacy. Now, I want to end where all of this really ends. With honesty, the dollar's role is still enormous. The Treasury market is still central. The old order is not disappearing by next week. Fine. But if you wait until the old order looks fully broken before you adapt, then you will adapt far too late. That is the lesson history keeps teaching people. Regimes are not usually abandoned when their weakness becomes obvious. They are abandoned in pieces, then defended in rhetoric, then managed through denial, and only later described accurately by the crowd. I am not interested in being part of that crowd. I am interested in seeing the architecture while it is still changing slowly enough to think. That is where I believe we are, at the slow enough stage, the stage when a few oil transactions matter, when alternative rails still look partial, when Treasury auctions are merely soft instead of openly frightening, when debt service is ugly but not yet politically dominant, when the saver still has time to reposition before the policy response becomes more blatant. That is the window. It will not stay open forever because once automatic demand is gone, the world must decide what the price of trust really is. And that price is rarely paid by the people who saw the problem first. It is usually paid by the people who kept telling themselves the old system would remain automatic, because it always had been. That is the final choice. You can keep thinking of the dollar system as an unbreakable habit. You can keep assuming oil still secures the same automatic bid, that the world has no practical alternatives, that weak auctions are technical noise, that giant refinancing walls are just another Washington statistic. And that reserve currency privilege is a birthright that does not have to be continuously re-earned. Many will, or you can do the harder thing. you can see that the dangerous change is not headline collapse, but habit erosion. You can see that alternatives do not need to win absolutely to weaken the old center. You can see that debt-weak demand and bypass infrastructure are forming a much more serious picture together than any one of them forms alone. And you can start preparing your portfolio, your savings, and your expectations for a world in which dollar demand is no longer quite as automatic. Treasury demand is no longer quite as forgiving. And wealth protection begins requiring more than faith in old slogans. That is the real edge. Not panic recognition, because once the world stops needing dollars by habit, the people still holding their wealth as if the habit were immortal will discover too late what the privilege was worth. And the people who understood earlier will already be standing somewhere else,